Did you know about monetary policy?
Monetary policy? Yes, of course I know. When talking about monetary policy is a set of tools that a nation's central bank has available to promote sustainable economic growth by controlling the overall supply of money that is available to the nation's bank, its consumers, and its businesses. There are four important things about monetary policy. First one is tools of monetary policy. Second one is transmission mechanism. The third one is monetary policy and the business cycles. And the lastly is limitation of monetary policy. Let's we go further about monetary policy. Let's go.
I'm going to introduce a powerful financial tool of monetary policy. I will focus on the three primary tools of monetary policy. First, more open market operations. Second, required reserve ratio. And third is interest on reserves balance. Open market operations is a crucial tool used by central banks to implement monetary policy. By buying and selling government securities in the open market, it adjusts the money supply and influence interest rates to achieve macroeconomy objective. The second tools I would like to introduce is the required reserve ratio. Required reserve ratio is a monetary policy tool used by central banks to regulate the money supply and liquidity in the banking system. It mandates the minimum proportion of deposits that commercial banks must hold as reserves in the central bank or in cash. These funds cannot be used for lending or investment, directly affecting a bank's lending capacity. If the central bank increase the reserve ratio, banks are required to hold more funds as reserves, reducing their lendable funds. If the central bank decrease the reserve ratios, bank can release more fund for lending or investment. As a result, credit supply increase, promoting economic growth and consumption. The last tool I will introduce is the interest on reserve balance (IORB). Interest on reserve balance is a monetary policy tool that refers to the interest paid by the central bank on the reserve held by commercial banks in their accounts. This includes both required reserve and excess reserves. The primary role of IORB is to help central bank influence market interest rate, thereby achieving its monetary policy objectives such as controlling inflation, maintaining employment, and promoting economic stability. If the central bank decreases IORB, banks have a higher opportunity cost to deposit funds with central banks and are more inclined to lend funds to the market or make investment. This increased liquidity in the market, promoting economic growth.
Excuse me, would you mind do me a favor?
Yes.
What is monetary policy transmission mechanism?
Do you want to know about monetary policy transmission and mechanism, or we known as MTM? MTM refers to the process through which change in a central bank's monetary policy influence the economy, particularly aggregate demand, inflation, and output. There are three keys in transmission mechanism. The first one is, second one, and the third one. There are three challenges. There are three challenges in transmission mechanism. Firstly, time's lag. Effect of policy change are not immediate and may take months or years to materialize. Second one is global interconnectivity. This problem, open economic face external influence such as exchange rate of fluctuation and international capital flows. Last but not least, structural factors. This challenge are effective of transmission depends on factors like health, banking system, and responsiveness of consumer and businesses.
Hi, good morning everyone. Today I will present to you about monetary policy and the business cycle. So the monetary policy is referred to measure taken by the country's central bank to regulate the economy. It aims to achieve the three key economy objectives. Like this, we have three objectives. The first one is stable price, low and control inflation. And the second one is low employment. And the last one is sustainable economic growth. So the central bank use the tool like interest rate, money supply, and open market operation. Okay. The second one is a type of monetary policy. Have two types. First type is expansionary money policy used during recession. For example, the central bank lowers interest rates and increase the money supply. And this encourages borrowing, spending, and investment. Business take a loan, expand production, and consumers spend more due to lower loan costs. For example, if the economy slow down, Bank Negara Malaysia might lower the overnight policy rate (OPR), making loan cheaper and help stimulate economic activity. And the second point is contractionary monetary policy. The central bank receive the interest rate and reduce the money supply. Discovered increase borrowing and spending, business and consumers spend less, cooling down demand, control and inflation. For example, inflation rise too high and the central bank increase interest rate, people borrow less and spending slow, stabilize price. Okay, and the next one is business cycle. Business cycle refers to regular fluctuation, economic activity over time moving through four the main phase. First phase is expansion, recovery. The economic growth, GDP increase, the employment fall. And the second one is peak, the economy reaches its high growth level. High demand may cause inflation. And the third one is recession or contraction. Economic activity decline, GDP fall, employment risk, and the business reduction production. And the last one is thought. This is the lowest point of the business cycle. So the last one is how monetary policy affect the business cycle. First point is during recession, central bank lower interest rate and increase the money supply. This encourage the business to grow, expand, and hire workers. Consumer also spend more. And second point is during boom or peak, when the economy growth too fast, inflation become the concern. Central bank raise the interest rate and reduce the money supply. This last point is balancing the cycle. Central bank aim to smooth out the fluctuation of the business cycle by stimulation growth during recession and controlling inflation during the boom, and monetary policy creates a more stable economic environment. So the conclusion is monetary policy is a vital tool for managing the economy through the business cycle. During the recession, expansion policy boost growth. During the boom, contractionary policy control inflation. By carefully placing three policies, central bank aim to ensure steady growth, low inflation, and minimal employment, creating the stable and stable economy environment. Thank you.
Lastly, I want to talk about the limitation of monetary policy. There is 6 cases for the limitation of monetary policy, and the first case is deflation. Compared to inflation is usually hard to control. During deflationary periods, central bank reduce their policy rates as low as zero. Secondly, it is case of banks decrease the money they lend. Sometimes when the money supplies rise, bank can have excess reserve, making the short-term rates decrease. This is mostly a result of the business environment. Other than the two cases I mentioned previously, the third cases is about uncertainty about how the economic reacts to expansionary and contractionary policy. The uncertainty about the effect of the policy puts the economic and price on a complicated path. Some economics might over or underreact to central bank policies. It is imperative to note that economists often disagree on the policies central bank should use.
Hold on. You
Oh.
had you left one more explanation.
Oh, I forgot about the last one. The last one is about a liquidity trap. A liquidity trap is when interest rates are close to zero and savings rates are high, rendering monetary policy ineffective. In a liquidity trap, consumers choose to avoid purchasing treasury securities and keep their funds in savings because of the prevailing belief that interest rates will soon rise.
That's all about monetary policy. Thank you. Bye bye.